Bitcoin itself it's the pure asset. It's the atomic level asset. So the value is it's the pure commodity within the asset without an issuer, and the most global, most timeless asset with the most optionality and the least counterparty risk. It's the global standard for a digital commodity.
Today, we're breaking down Michael Saylor's perspective on Bitcoin. Have you ever wondered why Bitcoin is often referred to as a pure asset? Saylor describes it as the atomic level asset, a global standard for a digital commodity. But what does this mean? In essence, Bitcoin is unique because it's a commodity without an issuer, meaning it's not tied to any country, company, or organization. This lack of counterparty risk makes it a highly sought-after asset. Let's delve deeper into its properties and understand its unparalleled value in the digital realm.
What are the challenges? The challenges are you can't finance it. So if you want to buy it, you have to actually establish a new relationship with the crypto exchange. You have to put cash up front. And so that could be a scary proposition. It would take a typical investor a year to vet a new exchange partner. And then they would have to change their charter, has different tax consequences. Sometimes they're not allowed to buy property or a commodity asset. They can only buy security. So it's a different type of asset with a different purchase channel. And then you have to come up with a custodian that you trust, or you have to come up with a custody protocol. So if you're a pension fund, the issue is which of the people in the pension fund get the private keys? Is it one person, 3 people, or do you trust a custodian? You'll probably have to choose an institutional custodian. So choosing an exchange and choosing a custodian, changing your charter, and vetting everything, that's going to take you a year. After you do it, if you want to buy $1 million worth of Bitcoin, you have to have $1 million in cash. That's the challenge. The advantage is you can hold it forever and you can transfer it to other counterparties without a taxable event after you've owned the Bitcoin. So if you're going to hold it for 100 years and you're really focused, then you want to own the asset, the pure asset. But if you're an agency, an endowment, an institution, a corporation, they typically want to be able to use their existing bank, and they want the bank to be the custodian, or they want the money manager to be the custodian. And they don't want to pay money. I mean, they want it on credit, right? So coming back to the home buyer, really, you just want to buy the house and get the bank to give you 100% mortgage, right? That makes it easy. A spot ETF would be the ability to buy that asset, and you buy it through your existing bank, like Bank of America or JP Morgan or the like. You buy it for almost no transaction fee. If you can get effectively a 5 or 10 basis point transaction fee or less in the ETF, you would buy it instantly. Instead of taking a year, you could do it in a minute. And instead of coming up with $1 million, you would just ask the bank to give you the $1 million of financing at 5% interest. So the bank will forward you the cash. It's like buying it instantly, no money down. And then you don't have to change your charter. You don't have to adopt or trust a new exchange. You don't have to trust a new custodian. Most of these institutions, if I were to say they've been doing business with the same bank or the same investment company for 20 years, that would be short. Most of them have been doing business with the same investment company for 40 years. Or 50 years. But 40 years is not unreasonable. So you're talking about a publicly traded company, Apple, Amazon, Microsoft, Google. They've got relationships since they were founded. They could buy $1 billion of Bitcoin in a minute, no money down, on a phone call. And no one would say a second thought if it comes through a spot ETF. But if they were to say, I want to buy $1 billion of Bitcoin, the commodity, they would need to have 16 board meetings, 100 lawyers and accountants review it. They would have to go through all sorts of contortions. They would have to dedicate a team of 5 people. They would have to draft 1,000 pages of operating procedures. There would be endless debate. and they would have to come up with $1 billion of cash. So the difference between Bitcoin and the spot ETF is profound for the institution.
Now, while Bitcoin's value proposition is clear, investing in it isn't without challenges, especially for institutional investors. Let's break this down. Firstly, traditional investors have to establish a new relationship with a crypto exchange, which can be a lengthy and rigorous process. Then there's the issue of custody, who holds the private keys, and how do institutions ensure the safety of their investment. But here's where it gets interesting: the introduction of financial instruments like the spot ETF. This tool could potentially simplify the process, allowing institutions to purchase Bitcoin almost instantly through their trusted banking partners. But how does this work, and what are the implications? Let's explore.
Now, the spot ETF is one-to-one leverage. You put $1 million in and you got $1 million of Bitcoin, and it's probably a fee anywhere from 50 to 100 basis points. So that means that every year you're going to pay up to 1% of your assets in order to hold that position. So what that means is over an indefinite time period, that means that 20% of your assets go to the trustee or the operator of the ETF or the money manager. So when you buy the Bitcoin directly, you might be able to get in size, if you used a custodian, you might be able to get to 5 basis points a year of a custody fee, at $1 billion or more. If you're a spot ETF, 50 basis points would be the cheapest. So 5 basis points times 20 means that if I buy $100 million of this, I pay $1 million in custody fees over the lifetime of the asset. And on the other hand, at 50 basis points, then when you buy $100 million of it, you have to multiply that by 20. And that means over the course of the duration, you pay $10 million instead of $1 million. So it's more expensive to go through that operator. The other advantage of having the ETF is there will be an options market and a put and call options market. And that means that you can sell volatility and generate yield of some sort by giving up upside, or you can hedge downside. It's not a strong options market, but it is an options market. Now go to the futures ETF. The futures ETF is probably double the cost of the spot ETF. And so now you're talking about, instead of paying 10 million over the course, you're paying $20 million. So you've gone from 1 million to 10 million to $20 million in manager fees. So it's gotten more expensive, but that's not the big cost. The big cost is you have $100 million invested and you lose 20% performance. So you've lost 20 million a year for 5 years, and you're losing all 100 million over 5 years. If you want to use a snarky phrase, right, you would say, the spot ETF is like you bought the beautiful house across the street and the bank financed it all. But the futures ETF is you bought the same house, but it's on a lot with a sinkhole, and the entire thing's going to sink into the sinkhole in 5 years. So you can see you don't really want to make your financial foundation on sinking sand. And that's what the futures are right now.
So let's discuss the costs associated with different investment vehicles. Spot ETFs, for instance, come with a fee, typically around 50 to 100 basis points annually. This might seem minimal, but over an extended period, it can accumulate. On the other hand, futures ETFs can be double the cost and might underperform over time. It's essential to understand these nuances to make informed decisions. Remember, in finance, understanding the underlying mechanics is crucial to navigating the landscape effectively. Thank you for tuning in to Unscripted Crypto. Now, we'd love to hear from you. What are your thoughts on the future of Bitcoin and its place in the institutional investment world? Share your thoughts in the comments below, and as always, stay informed and keep exploring the ever-evolving world of cryptocurrency.